There is a specific kind of investor that Wall Street absolutely does not care about. And it's not the pension fund, it's not the hedge fund, it's not the billionaire family office. I'm talking, of course, about the person with only $1,000, the guy trying to turn a small account into something meaningful while inflation eats his paycheck alive. The person who knows the system feels unstable, but also knows they don't have enough capital to make mistakes. And here's the true reality. Most financial advice completely breaks down at the $1,000 level because traditional finance assumes you already have money. Diversify, buy index funds, earn 8% annually over 40 years. That advice works if you already have 6 figures plus. But if you have $1,000, your problem is different. You are not trying to optimize wealth. You are trying to escape irrelevance. And that is where the Sprott Playbook becomes interesting. Because whether you agree with him or not, Eric Sprott has built a reputation around one central idea. When the monetary system gets distorted enough, small allocations into asymmetric hard assets can radically outperform traditional portfolios. Not because silver is magic, not because gold is guaranteed, but because markets periodically misprice reality. And when they do, small accounts can move fast. Today, I want to examine what I call the Sprott Playbook for $1,000 accounts. Not fantasy, not meme stock gambling, and certainly not options degeneracy, but a framework, a survival-oriented strategy for small investors who want to expose to one of the most volatile and potentially explosive asset classes in the world. And most importantly, how to think when you are undercapitalized. Because small accounts don't die from lack of opportunity. They die from emotional mistakes. So let's get into it. Section 1. Understanding the original Sprott thesis. To understand the playbook, you first have to understand the original thesis. Eric Sprott became famous because he viewed precious metals differently than most investors. To the average person, gold and silver are commodities. To Sprott, they were monetary assets. That distinction changes everything. If silver is just an industrial metal, then price depends mostly on manufacturing demand. If silver is also money, if it becomes a trust asset during periods of financial instability, then price behavior can become violent. And that's exactly what happened repeatedly throughout history. The Sprott worldview is essentially built on 5 ideas. Let's examine. First, fiat currency systems eventually become unstable because governments always overspend. Sound familiar? Second, central banks suppress the real cost of debt through money creation. Sound familiar? Third, real inflation is usually higher than officially reported. Sound familiar? Fourth, physical precious metals are structurally scarce relative to paper claims. And fifth, when confidence breaks, the revaluation of hard assets happens extremely quickly. Now, whether you agree with all of this is irrelevant, because the important thing is this. The playbook is about asymmetry, not certainty. Small investors constantly make the mistake of searching for certainty. But the real game is finding situations where downside is limited relative to upside. That is how small accounts usually compound. The $1,000 account cannot survive repeated large drawdowns, which means the goal is not constant activity. The goal is concentrated exposure to rare setups. And precious metals, especially silver, have historically produced those setups. Silver is one of the most psychologically difficult assets in the world. It crashes, it stagnates, and it frustrates people for years. But when it moves like a leveraged monetary instrument. And that volatility is dangerous, but for small accounts, it is also the opportunity, which brings us to section 2, why small accounts fail. Before I explain the actual framework, we need to talk about why most small accounts fail. Because this matters more than the asset itself. The average person with $1,000 behaves very differently from somebody with $100,000 or more. Small accounts create emotional pressure. Every loss feels catastrophic. Every gain feels life-changing. And that emotional intensity creates terrible decision-making. And here's what usually happens. The investor starts with a small account. They know they need a large percent return to matter. So they begin chasing volatility. Crypto memes, zero-day options, low-float garbage, leveraged ETFs. They confuse movement with opportunity. And eventually, they blow up. The Sprott mindset is actually the opposite. It says you only need to be right a few times, and that's it. You do not need constant action. You need exposure to a macro trend that can radically re-rate. This is extremely important because when you only have $1,000, overtrading becomes mathematically lethal. Transaction friction matters. Taxes matter. Mistakes matter. One notional options trade can erase 6 months of disciplined accumulation. So the first principle of the playbook is this: protect the ability to stay in the game. That means no margin, no leverage, no YOLO behavior, no despair trades. You are building optionality, not trying to hit a lottery ticket. And ironically, that mindset is exactly what gives you a chance to outperform. Which brings us to section 3, the structure of a $1,000 account. So let's get practical. If somebody handed me a fresh $1,000 account and said, build this using the Sprott framework, here's how one might maybe think about it. First, liquidity matters. A tiny account cannot survive illiquid garbage. You need flexibility. Second, you need layered exposure. Not all precious metals exposure behaves the same way. Physical silver behaves differently from miners. Miners behave differently from royalty companies. Junior explorers behave differently from producers, and each layer has different volatility. And the key is structuring exposure without creating a portfolio that can implode overnight. So here's the framework. Layer 1, of course, physical metal. Let's say about 30 to 40%, and that is the foundation. Not because physical silver is going to make you rich overnight, but because it changes your psychology. Owning real metal removes counterparty risk. It also prevents panic selling. People trade paper assets emotionally because they exist as numbers on screens. Physical metal feels different. You think different when you hold it. Now, at the $1,000 level, this isn't about buying monster boxes. This might literally mean a few ounces per month, and that's fine. The purpose is not immediate wealth. The purpose is creating monetary anchor outside the system. And psychologically, this matters. Which brings us to layer 2, large liquid miners, let's say about 30%. This is where torque begins. Major silver and gold miners can massively outperform underlying metals during bull markets. Why? Because miners have operational leverage. If silver rises from $30 to $50, mining margins can explode disproportionately. This creates equity re-rating. Companies with liquidity and survivability, not lottery ticket explorers. Small accounts love tiny speculative miners because they dream about 20x returns. But statistically, most junior miners fail. The goal at this stage is exposure without annihilation, which brings us to layer 3, speculative opportunity. Let's say about 10 to 20%. And this is where you allow yourself controlled speculation, not because speculation is bad, but because it must be contained. This bucket can include junior miners, silver explorers, high beta resource names, potentially even uranium or copper optionality. But the rule is simple. If this bucket goes to 0, the portfolio survives, and that changes behavior. You can tolerate volatility when the portfolio structure is designed correctly. So that brings us to layer 4, cash. That's right, Cash. Most people ignore this, but one of the most important parts of the Sprott mindset is understanding cycles. You need dry powder because panic creates opportunity, and small accounts become dangerous when they can buy fear. Most people cannot. They deploy all capital emotionally near tops. Then they have nothing left during collapses. Cash is strategic flexibility, not weakness. Which brings us to section 4, why silver specifically matters. So let's address the elephant in the room. Why silver? Why not gold? Why not equities? Why not crypto? And the answer is volatility. Silver sits in a strange position. It is simultaneously an industrial metal, a monetary metal, a retail speculative vehicle, and a geopolitical commodity. That combination creates instability. Silver markets are relatively small compared to global capital pools, and that means relatively small capital flows can create huge price moves. And historically, silver bull markets become reflexive. Price increases attract momentum. Momentum attracts retail. Retail attracts media attention, and media attention attracts institutional participation. And suddenly, the move becomes nonlinear. That's what happened in 1979, and that's what happened again in 2011. And you could expect it'll happen again at some point. And notice something important. I didn't say it will happen. That distinction matters because this entire strategy is built around probabilities and asymmetry, not prophecy. One of the great mistakes in precious metals investing is becoming emotionally married to apocalyptic narratives. You don't need total collapse for silver to work. You simply need persistent inflation, industrial demand growth, monetary instability, investment flows, or supply constraints. And increasingly, those conditions already exist, and you could argue are accelerating. Solar demand is growing. Infrastructure requires electrification. Grid expansion requires conductive materials. Defense systems require silver. And at the same time, new large discoveries are becoming harder. That doesn't guarantee explosive prices tomorrow, but it creates pressure, and pressure matters, especially in thin markets. And so now section 5, the psychological advantage of small accounts. Here's something most people don't realize. Small accounts actually possess advantages. Huge institutions cannot move quickly. They need liquidity, compliance, positioning, sizing, committee approval. You don't. A $1,000 investor can reposition instantaneously. That agility matters in volatile sectors, but only if you remain disciplined. The danger is that small investors mistake agility for recklessness. The playbook requires patience. That's the hard part. Because silver investing is emotionally exhaustive. Nothing happens for months and sometimes years. Then suddenly everything happens at once. Most people quit right before the move. This is why conviction matters. Not blind conviction, but informed conviction. You need a framework strong enough to survive volatility, because volatility is the price of admission. With no asymmetric upside, there's no asymmetric upside without discomfort. And honestly, this applies beyond silver. The real lesson of the Sprott Playbook is understanding how macro distortions eventually create nonlinear outcomes. That pattern repeats constantly in markets. Housing, tech, energy, crypto, commodities. The crowd extrapolates stability forever, and then suddenly repricing begins. And the people positioned early look like geniuses, but they usually spent years looking wrong first. Section 6, avoiding the cult mentality. So now I need to say something important. There's a dark side to precious metals culture, and small investors need to avoid it. Some people become permanently trapped in doom narratives. Every dip is manipulation. Every delay means collapse is imminent. Every catalyst is the big one. The mindset becomes destructive because eventually you stop thinking rationally. You stop evaluating evidence and you begin emotionally needing the thesis to happen, and that is dangerous. The correct mindset is probabilistic. You are not betting on the end of civilization. You are positioning for monetary instability and hard asset repricing. Those are very different things. The world can remain functional while hard assets outperform dramatically. In fact, historically, that's usually what happens. So avoid becoming trapped in ideological echo chambers. The best investors stay adaptive. If conditions change, they change. The playbook is not religion, it's strategic positioning. Section 7, time horizon is everything. One of the biggest reasons people fail in silver is mismatched time horizons. They enter with trader expectations. Then they encounter investor timelines. That disconnect destroys them. The Sprott framework only works if you understand cycles. Silver is not a smooth compounding asset. It is episodic. That means long periods of frustration followed by explosive repricing. Small accounts must therefore focus on accumulation quality, not daily validation. This is psychologically brutal in modern markets. Social media trains people to expect instant results, but asymmetric investing often looks stupid before it works, and the ability to tolerate temporary boredom is a competitive advantage. And think about that. Patience itself becomes alpha. That's rare. Most people can't do it, which is exactly why opportunities exist. Section 8, what would break the thesis? Well, let's discuss risk, because this matters. Every serious investor needs disconfirmation criteria. What would invalidate the thesis? Here are a few possibilities. If global monetary conditions normalized, if government suddenly became fiscally disciplined, if real interest rates stayed substantially positive, if industrial demand weakened structurally, if large new silver discoveries radically expanded supply, those things matter. And if evidence changes, positioning should change. Again, it's not the strongest investors in history were flexible. They adapted. They did not emotionally attach themselves to one narrative forever. So build conviction, but also build intellectual honesty. That combination is incredibly rare. So the real goal of the $1,000 account, here's the part nobody tells you. The real purpose of a $1,000 account is not becoming rich. It's becoming dangerous, meaning you are training discipline, pattern recognition, emotional control, risk management, conviction. Because if you cannot manage $1,000 intelligently, you will not manage $100,000 intelligently either. Small accounts expose emotional weaknesses brutally. That's why this phase matters. The Sprott Playbook is really about developing asymmetric thinking. How do you identify situations where upside vastly exceeds downside? How do you survive volatility long enough for the thesis to work? How do you avoid emotional destruction while remaining positioned for opportunity? And that's the game. And honestly, those skills matter more by far than silver itself. Because once you understand asymmetry, you start seeing it everywhere. And you begin recognizing distorted pricing, misaligned incentives, panic-driven sell-offs, structural shortages, narrative shifts, and suddenly markets stop looking random. Which brings us to the final section, the closing message. So when people hear the Sprott Playbook for a $1,000 account, they imagine some secret list of mining stocks. That is not the point. The point is the mindset. The point is understanding that small investors cannot win by copying institutional behavior. Institutions optimize. Small investors must exploit asymmetry. And precious metals, especially silver, remain one of the few globally recognized hard assets where that asymmetry may still exist. Maybe the thesis works spectacularly. Maybe it only partially works. Maybe it takes longer than anyone expects, but the framework itself is powerful. Stay solvent, stay patient, accumulate intelligently, avoid leverage, avoid emotional destruction, preserve optionality, and understand this. You do not need to predict the future perfectly. You simply need to position yourself so that the world changes rapidly. If it does, your tiny account exposed to the right side of the move. That's the playbook. And for small investors in unstable times, that may matter more than ever. And so if you enjoyed this video, subscribe to iBankerU, because we don't chase headlines here. We study systems, we study incentives, we study the movements where markets stop making sense. And those movements are usually where the biggest opportunities begin. And now you know the rest of the story for if you had a $1,000 account, how to start thinking about how to chase those asymmetrical returns. Build that stack. iBankerU. Good day.